Hello everyone, and welcome to Chapter 7, Internal Controls and Cash. So our learning objectives for this chapter is to explain the components of internal control systems. We will be including its control activities and limitations. We will look at control activities for cash receipts and cash payments. Bank reconciliation is a major part of this learning, and finally looking at reporting and management of cash. Now, the internal controls is the system that is adopted by the company to help make sure that its financial statements are reliable, that there is effective and efficient operations, and the company is complying with relevant laws and regulations. The companies also adapt these internal controls to secure their assets, to protect their assets. So it also helps them prevent and detect any error, which either could be intentional or unintentional. So with the good internal controls does have the 5 primary objectives. One is the control environment. There is risk assessment that has to be done by the business to see what is the amount or the level of risk the business is taking. Accordingly, they can go ahead and apply internal controls. Now, keep in mind the internal controls are going to come up with a cost. So the company wants to assess the risk that it's facing before they decide on the level of internal controls they want to establish. So the control activities that they can do, the information and communication once those internal controls are established, and finally monitoring the activities. So when it comes to the control activities are things such as assignment of responsibilities, segregation of duties, documentation, physical control, review, and reconciliation. We will look at each one of that in a bit. So your specific control activities used by the company will depend on the risk that it is facing and size and nature of the business. Once again, your cost benefit will come into play here. The business wants to evaluate the market that they operate in. You know, what are the chances of things going wrong? What is the risk that they are facing? For example, does the company want to install the retina scanners? It's going to come with the cost, but what is the risk that they are facing? So every internal control is going to cost them money. The question is, what is the amount of risk they are taking and what is it that the company is trying to achieve? So based on the size and the nature and complexity, they can pick and choose their internal controls. So assignment of responsibility is only people who are responsible for certain tasks should be the one performing them. For example, if I, as a controller to the business, do not have the authority to sign the checks, then I shouldn't be the one signing it because it's not assigned to me. Okay. If I have the ability only to do the electronic payments up to 300,000, then I'm only assigned for that particular piece up until 300,000, nothing over that. So with the businesses, generally these responsibilities are assigned. Okay, so any individual that does not have the assigned responsibility should not be the one performing that task because that's not the expectation. Okay, so for example, the other one discussed here is the cashier that has the responsibility for their own cash drawer, not for somebody else's. On the other end of the assigned responsibility is your segregation of duty. So segregation of duty is where we are trying to pierce out conflicting responsibility. Okay, so the responsibility for authorization and recording of transaction and custody of asset should be assigned to different people. So these are two conflicting duties. If you put them together, then the chances of errors and frauds are higher. So we want to reduce that. The whole idea of internal controls is to avoid those occurrences. So somebody that has access to recording the transaction shouldn't be the one controlling the asset as well. Let's say you have that bakery shop. So in the bakery shop, the person at the counter has access to the baked goods. That's the inventory, that's an asset. But let's say if it's the same person doing the bookkeeping, then if the person wants to pocket the change or cash from a cash transaction, then it will be hard to spot because inventory will go missing and there will be no cash recorded. Okay, so it gives them more ability to do that. So any conflicting duties in that regard has to be kept separate. So all purchasing activities such as ordering, approval, receiving of the goods and authorizing the payment, they have to be carried out by different employees. Documentation is one of the big aspect of accounting world. So basically what this means is there has to be evidence of the transaction. So any transaction and event that has occurred for a specific time period and amount, we have to have some sort of a documentation to be able to prove that. So when you say the FOB, let's say there are goods in transit. So when we include those goods in transit in inventory, how are you going to establish that? Okay, there has to be some purchase document, there has to be some sales document, there has to be some paperwork, a contract, okay, a shipping confirmation. There has to be something that you can go back to and prove it. So that is documentation. In accounting world, any item that cannot be verified or does not have enough documentation would be disallowed. Physical controls is what people put in place physically, such as the locked doors, key card access, lock and keys. Those are the physical controls that are put into any environment to physically protect those assets. Okay. The other examples are your computer passwords, your building alarm system, security cameras, safes, walls, you name it. Again, it depends on cost benefit. How much money do we want to spend on these internal controls in comparison to the risk we face? The last part of your control activities is your review and reconciliation. What that means is people should be reviewing the work of their fellow or their subordinates, making sure that it's free of errors. All controls should be subjected to independent review and checks, whether they are internal or external. The idea is not to find faults, but the idea is to make sure that the information is consistently and represented, which is free of any errors. Okay, so reconciliation process is one of those review items where we perform the bank reconciliations at the end of every month for every single bank account that exists. Now, regardless of what the company's risk environment is and what level of internal controls they establish and implement, there always are some limitations to the internal controls. They can only provide you with the reasonable assurance that your assets are safeguarded and your records are reliable. But there are still some limitations, which are your cost benefit consideration, as we were saying. There could always be human error that could come into play. Collusion is a big part of that. Collusion is where two parties come together with the intent of committing fraud. So let's say if we go back to our same example of bakery store, where the person have access to your baked goods and was doing the bookkeeping as well. Let's say the manager figures out that this is not a good segregation of duties, they are conflicting. So he hires another person to do the bookkeeping. But this bookkeeper is friend of the person that is selling the baked goods. Now you got two people, you're trying to segregate the duties, nothing wrong with that, but they could still come together with the intent to steal from the business or to commit fraud. That is collusion. And then the management override. So regardless of what is the level of internal controls that the businesses do implement, there is always some limitations to those internal controls. They are not foolproof. On the other hand, there is fraud. Fraud is human error is acceptable in business world because it's unintentional. But fraud is intentional act to misappropriate or steal from the business or to misstate the financial statements. You know, it's not always stealing something from the business. It could be misrepresentation of financial information, which is equally bad. So there is always that possibility of fraud or misstatement. So some of the examples of that misstatement is you are recording your expenses as asset. Okay, you have spent a bunch of money on advertising, and you know that there is no future benefit to that. but you are recording that advertising expense as an asset. That is a misstatement. You are overstating the useful life of your asset. So remember, this is in the depreciation context. So if you're overstating the life of your asset, that means the depreciation expense is going to be smaller, which means your income for the period is going to be higher. Okay, this is also misrepresentation. Recording the revenue ahead of time. You haven't earned the revenue, but you're recording it. Let's say it was a liability, but you're recording that as a revenue. Or the revenue is not earned up until next time, but you're recording it in this period. So your misrepresentation when it comes to financial statement can be of different nature. This is the example we will look at in class, BE 7-4. But moving on to our control activities. So cash is a highly um, liquid asset. It's one of the most liquid asset that there is. Because of that, it is very susceptible to theft. So what actually consists of cash is your coins, currencies that you have, any money orders, any checks written by your customers are also considered as cash. Okay, so any money in your checking account, saving account, in your bank account that you have is cash. So the general rule is if the bank will accept for deposit, then it is considered as cash. You could have your certified checks here as well. So a lot of different types of cash. Now, over-the-counter checks and electronic funds transfer is also cash. EFT is the money that comes directly to your bank account. Okay, now there are a couple of ways the company can get paid. Either their customers can write them a check, which pretty much used to be the old way. Some companies, a lot of companies actually still do that, but there is a moving trend towards the electronic payments, which is your EFT. So that is also cash. EFT is the money that actually comes into your bank account directly. That is your cash. So your internal controls over cash receipt is more effective when your cash receipts are deposited into the bank account daily, or there is an electronic funds transfer. So what that means is for the businesses who are transacting in cash, not a whole lot of businesses do that. If you think of it, but at the same time, we say that the accounts receivable, the checks that are coming in for accounts receivable, they are considered the same as cash. So the business might not be transacting in cash, but when they receive those checks coming in, it is treated the same as cash. All right. So the good practice when it comes to those cash receipts is to go ahead and deposit those checks in the bank on the very same day. Okay, that is one of the practices that we follow. So at the beginning of the day, once the mail comes in, we go through the mail and all the checks come to me. So then I take the inventory of the checks to say what all checks are there, who wrote it, and how much is the total deposit coming through. Then I give those checks to my AR lady who would go to the bank and deposit them. As soon as she has deposited, I will check the bank account to make sure that the amount deposited is exactly the same amount that I have, to ensure that none of those were missed in the process, or there were no errors from the bank side when they posted it. But the easier way to deal with that is, if you want to avoid that, you can always ask your customers to pay you through electronic funds transfer. So the money comes directly to your bank account. So these are the control activities that we implement over cash receipt. So we always assign responsibility. People that are designated to handle the cash are the only ones who would do that. Okay, so in this case, I have one person who would deal with all of the incoming payments or the checks. That is the person that has the assigned responsibility. Segregation of duties, we make sure that the cash is handled differently from the recording. Okay, it's not the same person handling the cash or the recording. And with the smaller organization, it does become a bit of a challenge to segregate those duties because, it's going to cost you more money. So then cost benefit will come into play. So what we do is, if you do not have multiple people to run these conflicting duties, then make sure you have compensated for that in other ways. So what I do is I have the same person recording the payments as well as depositing the cash. The way I deal with that is as soon as the person has deposited the cash in the bank or the checks in the bank, I make sure to check the bank on the same day to look at the differences and see if there is anything missing. Okay, that way, if there are any errors or misstatements, you would know it right away so that you can deal with it. Documentation, we use the remittance. So anytime we write a payment or the payment comes in, there is always a payment advice or a remittance copy that is attached to the checks, which is used for record keeping. When the checks are deposited in the bank also maintains electronic copies of these checks for up to 7 years, which is in line with CRA's documentation requirement. Then we have physical controls where the cash, if the business is actually dealing in cash, let's say you're looking at a small mom and pop kind of store and they actually do transact in cash, then in that case, you do need to have the physical control where your, those cash drawers are actually locked in and they're tied to the till. If you think of walking into Walmart, the till, when the teller is running your items and they tell you you owe an X amount, the till drawers will only open if the person says you are going to pay in cash. If you are paying through a credit card, then those till drawers will not open for cash disbursement. Okay, so that is a control procedure. And finally, we have to make sure that there is review and reconciliation. So if you think of the same example, so you're at Walmart and you have paid for this cash. Now, either you paid for cash or you used a credit card. So now think of this from the seller's perspective. So the person on the till is responsible for the money in that till. Okay, so once in the day, their manager will come by and both the parties agree to the amount of cash that there is in the drawer and how much was collected. So both the parties agree to that, they count it, they sign it, and off they go. That is assignment of responsibility as well as review and reconciliation of that process on the same day. So in case something does not reconcile, you want to know that before it's too late. So control activities for cash payments. Now cash is two ways. Cash is either cash coming in or cash going out. So when the cash is going out, you're practically writing out the checks. So when the business write out the checks, those checks are seen as cash as well. The best way is to write out the checks. You can pay somebody in cash as well, but when you transact in cash, those transactions are hard to substantiate down the line. In future, you cannot substantiate those transactions. It's he said, she said, okay? My word over the other person's. So in that case, it's always prudent to go ahead and write the checks because the banks will maintain copy of that checks for 7 years. Alternatively, if you want to go the easier way, then you can just pay them through electronic funds transfer. Okay, so try to stay away from the cash payments as much as we can. So these are the control activities that are implemented over cash payments. So assignment of responsibility, segregation of duties, documentation, physical control, review, and reconciliation, which you notice are the same as the cash coming in. So whether it's the cash coming in or cash going out, you need similar control activities. Now, the use of the bank. Now, the banks are used by all businesses. So all of our account or the cash that we talk about is in the bank, right? Now, that creates two places of records. One place of record is your bank. The other place of record is the books. Okay, so if I have written out a check today, then from the business's perspective, that cash has already gone out of my account. But there would always be some timing differences when it comes to two different sets of books, which is the bank and the books. Okay, so the check goes out in mail. It will take a couple of days for the receiver to get the check. Then they would go ahead and take it to their bank. Then their bank will contact my bank. And then finally the money is cleared. So it's a bit of a process. Okay, so When there is timing difference between two ends, between the beginning and the end of that transaction, that could likely create some discrepancies between the numbers on the books and the bank. All right, and that is why we will have to follow the process of reconciliation. We'll talk about reconciliation in a bit, but this is really what happens on the banks and the book side. So on the books, always try to think of the books first because that is the easier side, and then we can do the exact opposite for the bank. So if we are receiving a deposit today, so the customer has written out a check to us, which is incoming check, seen as the same as cash, that is a debit to our cash account. It's going to increase the cash on our books. Okay, but it's the exact opposite for the bank because it becomes a liability for them. Likewise, when the business write out the checks to their vendors for the payment, that check is credit to the cash account, which means the cash account will be reduced, but it's the exact opposite for the bank. So why the differences exist between the bank and the books is because of the timing differences. So if we have written out the check today, and then the check will go out in mail, the receiver gets it, then they take it to their bank, so it's a whole process. So the time between business writing the check and it clearing the bank, that is the timing difference. So let's say we wrote out the check on the 25th of the month. The check goes out in the mail, but it does not clear the bank till the following month on the 5th. Now, when your bank statement comes to you at the end of the month, it will have no record of the check that you have mailed out, but your books already have that information. Okay, so that is where it's going to create a bit of a discrepancy between the numbers on the bank and the book side. So timing differences of the cash coming in and going out is one example of that. The other difference is your errors. If either party, which is your bank or the books, has committed an error, then that will throw the numbers out as well. And this is exactly why we need to follow the process of adjustment. So when we are reconciling the bank account, this will reconcile the balance as per the bank account with the cash balance that we have on our general ledger, which is your books. So both the books and the bank balance are reconciled to their adjusted cash balance. So once your reconciliation process is completed, the adjusted balance on the book side and adjusted balance on the bank has to be exactly the same. So this is your bank reconciliation process. So cash balance as per the bank statement is reflected on the left-hand side, and cash balance as per the company's books is reflected on the right-hand side. Now, depending on what item you are looking at, okay, we will have to adjust the appropriate side. Now, there are a few things that can happen with the bank reconciliation. From the company's perspective, if the company has written the check to their vendor, on the company's books, the check has already cleared and the check has reduced that cash account, but the check hasn't cleared the bank at the end of the month. The check clears on the 5th of the following month. So this item already exists on the book side, but we need to adjust the bank side because it's missing on that side. So we will go onto the bank side and deduct that from our cash balance because this is an outstanding check. Outstanding check is an item that is already recorded. It's an outgoing cash payment that is recorded onto the books but missing on the bank side. So the whole idea of bank reconciliation is to look at each transaction and ensure that it shows up on the books as well as the bank. If it does, then that is a completed transaction and we don't have to worry about it. But the transactions that are missing on one side or the other are the ones that we will have to account for. Okay, so that is your outstanding check. Now, what else could happen on the book side? We might have received the incoming checks from the customers. So let's say the incoming checks came in on the 29th of the month. We took those checks to the bank, but the bank needs a couple of days to process those payments. So when the bank sends the statement at the end of the month, at that point in time, there are no records of these payments clearing the bank. So this will be incoming cash. Before we took the checks to the bank, we as in business have already recorded the cash. So we have debited cash, we have credited accounts receivable before those checks went out to the bank. So that becomes deposit in transit. They already exist, the cash already exists on the book side. We will adjust the opposite side, which is the bank. So we will increase our cash balance on that side. The other thing that can happen on both the sides is the error. Errors are a special item. Depending on which side the error originates on, we will adjust that side. So those are the things that could originate on the book side and we are adjusting on the bank side. Now thinking of the items that can originate on the bank side and are missing from the books. Only two possible items. One is the bank fees. The business only knows about the bank fees when they get the statement at the end. It exists on the bank side, the books don't have it. So we will have to go ahead and reduce our cash on the book side. The other thing that could come into play is your electronic funds transfer. So a customer paid, the bank is reflecting that money coming in, but we are missing it onto the books. So we will go ahead and increase the cash balance on the books. And if a payment comes back non-sufficient funds, then we will deal with it when we are looking at the example. Non-sufficient funds is when the check was written out, but the check never cleared. So let's say if the customer wrote a check to us and we went ahead and recorded the check onto the book. So we debited cash, credited accounts receivable. But when we took the check to the bank, the check bounced. It came back non-sufficient funds. So the writer of the check did not have enough money for the check to clear. So in that case, we will have to make an adjustment onto the book side. We will have to restate the accounts receivable for that customer who wrote NSF check to us. Once all of the transactions are accounted for under the bank rec, then your total for the books and the banks should exactly be the same. And these are the items that we were talking about and their effect onto the cash account, whether the cash will go up and down and on which side. Errors. With the other transactions, which we were talking up until now, which is your outstanding checks, deposit in transit, EFTs, as well as your bank charges. With those four type of transactions, we always look at the originating point. Where did this originate? And we will adjust the opposite side. But when it comes to errors, the errors are adjusted on the side that they lie on. We will not adjust any other side. So with the errors, the easy way to look at errors is there are four types of errors that can technically happen. There can be overstatement of deposits or understatements of deposits. There could be overstatements of the payment that we are making or understatement of that. Now, the easiest way to remember that is through this 2x2 table. Now, the errors can only have two effects, whether it's a deposit, that is the money coming in, payment is the money going out. The only two things that can go wrong with the money coming in or going out is either there are too many zeros or too less. So either that's overstated or understated. Okay. Now remember mod. Mod is minus overstated deposit. So find the 2x2 in the 2x2 box, find your box which is for deposit overstated. That difference will be negative. The box next to that will be opposite, opposite, and opposite. So that way you will complete your 2x2 table just by remembering mod. minus overstated deposit. So if your deposit was, let's say, overstated, the deposit came in for $100, but we accidentally booked that for $1,000, then your cash account is overstated by 900, which means we need to bring it down, which is a negative here. Okay, so we will have to credit our cash account by $900 because it's overstated. So that's what that negative is. Once your bank reconciliation is ready, then your total of adjusted cash balance on the bank side will exactly be the same as your adjusted bank balance on the book side. Once we know that both of those sides align, then we will book the journal entries for all the items that shows up on the book side. We will not journalize anything on the bank side because we just don't have access to those books. We only have access to the business records. So any adjustment that shows up on the book side is what we will do a journal entry to adjust, but nothing on the bank side. So half of your journal entry always is a debit or credit to cash account because bank reconciliation is entirely about the cash account. So if your cash is going up, you debit the cash. If your cash is going down, you credit cash. So that is half of your journal entries when you're booking that on the books. And these are all the examples that we will aim to get through in class. Now, how to report cash. So for the most part here, guys, I am covering the internal controls, the details on the internal controls, as well as how to report cash in these lesson notes. But generally speaking, this is the expectation of student reading. Okay, other instructors might or might not cover this. This is up to the students to go ahead and review. But I have tried to cover this in the slides here and in the lesson notes. So the cash is reported on the statement of financial position as well as your statement of cash flow. Now, when we talk about the statement of cash flow, that will show the receipts of cash and the payments of cash. So it will give you the cash coming in and the cash going out. And cash being the most liquid asset will always be the first one when you're looking at your statement of financial position under the asset section. So under current asset, it will be the first item all the time. Now, cash is also with the cash equivalents, okay? So technically speaking, in the real world, there is one account that the businesses use called as cash and cash equivalents. Now, we said cash was your checks, your money that is sitting in the savings account, checkings account, money orders, okay, coins, currencies. That was what we discussed on the cash. So what's cash equivalent? Cash equivalent is a short-term investment that is held for trading, which is highly liquid, and this is coming due in 90 days. Okay, so short-term, highly liquid, held for trading investment that are subject to insignificant risk of change in values are seen as cash equivalents. So if the cash is in deficit or overstated, overdraft at the end of the year, then it is reported as current liability, which is your cash indebtedness. What that means is, generally speaking, for the businesses, they have their line of credit tied to their cash account. So line of credit will allow the businesses to keep making payments even when their cash account goes negative. That is your indebtedness to the bank. So that is what the business owes as a current liability to the bank. Okay. Otherwise, if you have positive cash, then that is your current asset. This is how we manage the cash. This really is um, up to the managers or the accountants to determine how they want to manage their cash. They can increase the speed of their accounts receivable. And that requires constantly managing your accounts, calling up your customers, letting them know that they need to pay on time. You want to keep your inventory levels low. You want to monitor your cash payments that are coming in and going out. When you're paying for your liabilities, you need to have the cash coming in. So you have to have the cash coming in from your customers. So make sure that you're on top of that. Only then you can pay your liabilities. Don't pay it ahead of time. Then we plan on the timing of the major expenditures. We look at when we are going to have the cash, and that is the time we are going to spend it. We are not going to start spending cash today when we don't have it. Okay, doesn't make logical sense. And if we do have some idle cash sitting around, then we would try to invest that to make some more money. And we always want to do the daily, weekly, cash annual forecast and budgets. So managing cash is a vital aspect of any business. This is the example that we will be looking at, and when it comes to this chapter, there are no significant differences when it comes to ASPE and or your IFRS. So this is all that I have for this particular chapter, guys. Thank you for listening in. This is me, Guru, signing off.